our focus is really going to be on talking about the role of VC investment from the perspective of UK tech scale-ups. So that's our focus as part of Scale Up Week. House rules, if I may. We're going to recommend everybody keeps their mics off. You're welcome to leave your video on or off as you prefer, but if you can leave your mics off, and if you've got any burning questions to be added to the panel discussion, please type them up in the chat. I'll do my best to spot them and raise them probably at the end of the initial discussion, if that's okay. So we should be in and out before 1 o'clock. And if Amy, was there anything I've missed?
No.
No.
Great
Okay.
start. Thank you.
So with no further ado, let me hand over to Irene Graham, who's one of our good friends and is the CEO of the ScaleUp Institute and is responsible for lots and lots of things, not least of which putting together this ScaleUp Week. So over to you, Irene. Thank you.
Thanks so much, Ian, and great to be with you all today. And just fantastic to see Whitehorse bring this community together and to see the champions of scale-ups and you, Ian, Piers and Ed taking part in that. It's very clear to us, the scaling economy, those businesses of you in this group now listening to this, you are key growth champions of the UK economy. There's around 33,000 of you that are scaling up at 20% and another 16,000 in the pipeline who are scaling at sort of 15 plus. But together you contribute nearly 1.5 trillion to the UK economy, which is over 50%, nearly 70% of the overall SME economy. And that's why it's so important that we're focusing on scale ups and scaling businesses today, because you make such a difference to the UK. You're across the country, and you're very innovative and you're very international. And one of the things our scale up businesses tell us is they don't perceive there's enough financing available for them. They're not sure how to connect to it. So this is why it's so important, this session today, because what we know and observe is that those businesses, those of you that take VC and equity capital, really do grow faster, because it's not just the capital that you get the expertise of individuals that can connect you to markets, that can mentor you and support you through the journey and access to peer networks. So I know Ian and Piers and Ed will talk about that today, and it's really important as well, I think, just to flag, the British Business Bank is doing a lot of work to make sure we get that capital across the country to all of our scale ups, and also that you get the knowledge of how to go about accessing that capital. So it's great to see Piers part of the team today, not just from his entrepreneurial experience, but also the role that the British Business Bank plays. So thank you, have a great session and keep scaling and go for that, learn about how to get that investment today. Thank you.
Thank you, Irene, and much appreciated to have you here, and good luck with the rest of Scale Up Week. So then, by way of brief intro, so you know my context here. I've been in your shoes. I was building my own businesses as an entrepreneur, and I took on VC funding to grow my business. I did a series of acquisitions, some of which Piers Linney helped me with way back in 2004, 2005, and that moved me ultimately to achieving a trade sale and moving into the wonderful world of investment. Within that, I've been a partner at Whitehorse Capital, and we are an investment and advisory firm, and we've advised on over 370 million tech transactions. So we kind of hopefully have got a rough idea what we're talking about. And I also proudly chair the Accelerator network, which provides support and training, mentoring and capital for over 1,000 startups earlier in their journey. And that's informed some of my learning and experience of making sure companies make the leap from startup to scale up and from seed stage to Series A. So that's me. And then in terms of this session, the idea is that we can demystify some of the theories around VC funding. And quite often what we see is lots of opinion banded about on social media and taken as fact. And particularly if you've not raised money for your business before, or you've raised a seed round but you haven't raised from VCs, it can be difficult to know what to believe, particularly because a lot of the noise out there is contradictory. So that was really the goal here, was that in a short session we could try and help you understand from those who've raised VC funding, and from Edward, who is a VC, and will introduce himself in a minute, and also from Piers, who's been on basically every side of that dynamic. And so you can hear from us a little bit of kind of what works, what doesn't work, what sometimes goes wrong, and how to maximize your chances of succeeding if raising Series A investment is for you. So that's the goal of the session. Edward, did you want to kick off with your introduction?
Yeah, definitely. Please, if that's okay. I don't want to go after Piers, that's for sure. So I'd much rather go first because that will help my introduction. So thanks first of all, Ian, for the invite into the ScaleUp Institute. It was really pleased to be here, and thank you very much for asking me to witter on a little bit. So I'm an investment principal at Octopus Ventures. For those that know Octopus, we're one of the most active VCs in Europe, managing about 1.5 billion in total in that sort of early stage and scale up phase company. So we're a fairly big player, certainly the biggest venture capital trust and sort of manager in the UK. My role is basically overseeing deals, so overseeing the execution of deals, sitting on the boards of our portfolio companies, and sitting on the investment committee and giving investment managers a hard time. I've had a fairly long career at Octopus. It's been sort of 13 years now, investing in everything. I started off actually investing in sport, which was an awful lot of fun. Then moved on to sort of energy, which was less interesting. And then for the last 4 years, been investing into B2B software businesses, and that's my real focus. So sort of 4 or 5 years ago, that was kind of just getting interesting. Now everybody seems to be a B2B software VC. So that's me. Outside of work, I sit on the own network at the Oxford University as an entrepreneurial expert, so helping sort of early stage companies and advising them. I've also got my MBA from Side Business School at Oxford University, so quite linked in with their LIBOR project over there, helping businesses scale. And outside of that, as a dyslexic investor and somebody that sort of struggled at school, I try and help students in their kind of start of their careers or the end of their schooling, kind of making their decisions and giving them a path and an opportunity to maybe do things that they didn't think were possible through Career Ready. So that's me. Hopefully that's all right, Ian. Does that sort of tick the boxes?
I mean, if I'm asking for any more, it just means you'd have had to work harder over the last few decades. So no, that's a brilliant summary of all of the many things that you're involved in that are particularly pertinent today. Thank you. Piers, do you want to introduce yourself if you need introduction?
I probably do actually. People think they know me, but they often don't. So it's great to see Ed. Great background there, and Irene. Good to see you. It's been a while actually. We need to catch up. So my background is I've been on TV. I've been a Dragon on Dragon's Den and Secret Millionaire. You might know me from that. My background actually though is I was a venture capital lawyer in the city. That's where I trained, and then I left law and I became a banker. So I was a banker at what became Barclays Capital, Visa W, then Credit Suisse, First Boston. So I was kind of a mergers and acquisitions specialist, really, cross-border M&A. Did that for a few years, and then I went into business. I've always been in business. I met Ian about this time actually, probably early 2002, and I was in business in the sort of music industry straight out of my banking job. People could afford to start businesses then. And I was sort of in .com area, music, and then I went back to finance actually. So I spent a lot of time sort of raising money from US hedge funds to invest in UK, German, and US companies in special situations. And I tried to do the first SPAC, they're all the rage now here in the US. I was doing SPACs in 2004, I think it was. And then I basically went into business. So I've been mostly on technology, a little bit of media, some with Ian, and mostly telecoms and the convergence of the two. I've had some successes, some haven't worked out quite to plan. And I've been an investor, both kind of VC, a sort of a tech fund back into the 2000 vintage, and also been a hedge fund manager. So doing private investment in public equity, so structured finance of small cap companies. I got the honor, really, to be honest with you, of joining the board of a British Business Bank. So I'm a non-exec. So to give you an idea, we are actually the largest investor in the UK LP in investment funds and small and high growth businesses in the UK. And we went from 10 billion-ish of funds facilitated to 90, to give you an idea of what happened during COVID. So that's been a very interesting time to be on the board of the UK Government Development Bank. And I'm still in the game. So I'm still raising finance. I'm starting a new business focused on helping sort of small businesses grow essentially, reduce risk and embrace technology to solve our productivity issue. I might come and talk to Irene about that. So as Ian said, I've sat on every side of the table really. So I've got a perspective of everything from raising money to investing money to starting businesses successfully to refinancing into, going into administration. I've been there and got the t-shirt, and it's good to be invited. Thank you.
No, brilliant. Well, thank you for joining us, Piers. So hopefully for our audience, you're going to be hearing some things that might have taken you a lot of time or a lot of money to figure out on your own. So my first topic then to ask you is really, if we're going to start at the start. So what is the role of VC funding? What's it there for? Is it there for purely for growth? Is it an alternative to debt finance? Is it all about giving shareholders a bigger return? Is it about making rich VCs richer? What's your take on what the purpose of VC funding is?
Who do you want to go first? I'll give you my perspective. It might be a bit more sort of general. So it depends where you are in the world as well. So in the UK, and again, Ed, feel free to kick in, is in the UK, the background of venture capital really, and this is why you tend to see it structured in the way it is. It came very much from, some of you may have heard of 3i, and maybe you haven't, which is a kind of quite similar to the BGF in a way back in the day. But it was kind of management buyouts. It was buying companies that had succession issues, or it was a management buyout or a management buy-in. And that's where a lot of the institutional capital, especially in the mid-market, I'm talking about venture now, that's where it went. So when I was a young venture capital lawyer in a firm called SJ Berwin, that's no longer around anymore, it was all about these funds, raising lots of money. Actually, SJ Berwin helped kind of invent the fund structure in the UK, investing lots of money and investing in these sort of these entrepreneurs who were buying out these businesses. And he got private equity as well, which is probably a bit different to what we're talking about today. So ventures had a really important part in helping, businesses in some ways sort of grow, but also, move on to succession. Now it's changed quite a lot. So you had the kind of dot-com era boom, and a lot of money came into the market, and then there was a bit of a bust, and a lot of money sort of dried up because especially the US and overseas investors, it kind of dried up and it was repatriated. And we had a bit of an issue here in terms of a funding gap. And what you've seen over the last sort of 5-10 years is that funding gap, it was also exacerbated by the credit crunch because the banks pulled out of the market as well, and so did the equity. So there's a bit of a bigger gap in the middle. But what we've seen now, I think, especially with technology and especially in sectors like B2B, software as a service, is you've seen more money flow back into the market. And that's partly been because, especially in the UK, there's more activity now. And also, British Business Bank is sort of helping young and new fund managers set up funds to try and close that gap. That's why the bank exists. The banks, they're not playing equity, and they shouldn't be, so they're kind of still doing what they're doing. And the bank again helps, through guarantees, trying to pull them back into the part of the market where they should be operating. But the scale ups, and with what we're talking about today, are, as Irene said, I was just doing the maths there. It says 70% of the sort of SMEs, and that's about 35% of our GDP and 42% of private sector employment. So it's massively important that these businesses have the ability to grow. And what I know from my role at British Business Bank, one of the big issues is access to finance. So growth, recovery from the pandemic, access to finance, innovation, and what typically all venture is at the end of the day is that you have an opportunity to grow a business, to innovate, to bring new technologies to market, and you don't have the finance. It might not be personal finance, it might be your personal network, it might be an angel network. And I've got a YouTube channel actually, I've got a video on there about these concentric rings where you might start with your own money, you might start with family and friends, you pre-seed, seed, you might get to angel investors, but at some point you might need a decent sized check, which is what the ScaleUp Accelerator focuses on too, and the Whitehorse, where you might need to raise 1, 2 to 3 million. And that's not the kind of cash you're going to find from friends and family. And you need institutional funds that have this ability to put those kind of sums of money to work. And that's where venture capital kicks in. And what it's doing is providing finance that allows you to, invest and grow where you haven't got access to it, or your business essentially isn't creating sufficient profits to provide that capital to reinvest at the pace you want to grow. And what venture does, what venture wants, is a higher return for that. It's about risk and reward. So the bigger picture is, and I will shut up, the bigger picture is that in that kind of portfolio, in that landscape of investment opportunities for institutions, yes, they've got debt, they've got credit, they've got bonds, venture is the kind of the high risk, high return part of the market. So a lot of the people who invest in venture capital funds are pension funds, family offices. That's where the money's coming from, and they'll balance that in a portfolio with other less risk assets. So in UK venture, I think has come on a long way. I've had some criticism of it because I think the kind of MBO background. I'm of the opinion that it's good to be a VC if you've actually been involved in building business, got some experience, rather than just being an accountant or management consultant. But I think we're seeing it really change over the last 5 years, and that's a change for the better. And it plays a massively important part of the market. It's not for everybody, but the capital is really important, and we're seeing more and more of it, hopefully, from what we're seeing coming into the market. Europe has been an issue, so a lot of the money came from Europe. Hopefully, from the government strategy, we're going to plug that hole as well.
Brilliant, thank you. And Edward, from your perspective, I'm conscious you've probably got a slightly different view because you're inside a VC as opposed to kind of the LP side funding VCs. What's your view of the role of VC has to play?
Yeah, it's a really good question, and I enjoyed listening to sort of Piers' explanation because I think the history is quite important actually in terms of mindset, and then that's why I often hear people talk about West Coast VCs in America just being that much further in their evolution than maybe we are. I think there's an important point just to be clear on is that we talk about VC as being a very singular thing, and there are many different VCs out there. There are many different types of VCs that are going after different types of companies. So for example, just within Octopus ourselves, we have a team that looks at nothing but deep tech and AI. I would be a hopeless VC in that area. I'm not clever enough. I don't understand half of what they're talking about. We have teams that are looking purely at health tech. We have teams that are looking purely at consumer businesses. And so I think we have to be careful not just to talk about VCs as a one thing. But I would say that I think Piers touched on a really important point, which is, a lot of the early stage stuff might be friends and family. And then as the checks get bigger, it gets to the point where actually, you can no longer go to friends and family, and you need an institutional check, and hopefully, broad brush VCs of that check to come in. And their role is wider than that as well, because their role should then be to add value. I mean, we at Octopus, for example, we have a talent team within our VC team. So purely just within Octopus Ventures, we have a team dedicated to talent in the portfolio. So finding the hardest thing for any scale up is to find good people, especially good tech people. So that's super important, and we have a team that does nothing but helps our portfolio do that. And I do think the VC landscape it continues to change and develop. As Piers has said, it comes from that MBO background, but I think maybe a few years ago you had the whole blitz scaling revolution, and what was VC for? It was for just throwing as much money and growing as big as you could as quickly as you could. And actually that seems to have scaled back slightly, and now people are thinking a lot more about things like efficient growth. And yes, there are VCs out there that will just focus on trying to blitz scale companies and give them huge amounts of money. For us, we look very closely at growth efficiency, and if you're loss making, that's fine as long as you're growing efficiently. But if you're loss making, you're not growing efficiently, then it's probably not one for us as well. So again, I think there's many different types of VCs doing different things. And the one thing I'd add in terms of where money comes from, I think the UK has a massive head start over a lot of countries due to our venture capital trust and EIS schemes and SEIS schemes. These are absolute gems that we have in the kind of UK VC ecosystem that other countries don't have and are quite jealous of. And I think it's super important that groups like the ScaleUp Institute help us protect VCTs and EISs as much as possible and those tax efficient schemes, because it is putting huge amounts of money into the right places. I know maybe 5-10 years ago they weren't, all the money wasn't going into the right places, but I think now if you look at what's happening, it absolutely is. So I think that's an important source of capital as well.
Great, thanks.
Ian, can I add?
Sure.
I would also add this very quickly, is I think what we've also seen a change from as the markets evolve from the kind of MBO VC background to the one that Edward's just described, is that change from what's kind of financial engineering. So you buy a business at 6 times, you grow the business to hopefully you double the sort of the cash flow, and then you also sell it at 8 times. So there's a tick up there as well. It's moved a lot from that, I think, to, and this is what I'm quite focused on, is backing, you know, founders with businesses where the rewards are huge because you can scale these things, you know, globally essentially, and then you can lose your shirt completely. So the risk profile is completely changed. You know, in the kind of financial engineering background, you can lose money, but you probably weren't going to lose the business. Whereas in this new world, it's a very different model, I think, and you've got to back people and engage with entrepreneurs in a very different way, but the stakes are higher.
So if I'm going to try and bring that together, it feels like there's lots of different sources of capital going into the venture market, and we've got a tax benefit in the UK, which is particularly adds to the attractiveness of venture funding. But venture funding itself, from an entrepreneur's perspective, is to fund growth that the entrepreneurs can see, can identify, but can't realise with their own cash. And hopefully, across the plethora of opportunities of venture, there are different types of VCs, with some with more value add. Edward and his example of recruitment support, but essentially all of these VCs are looking for an ambitious growth plan and a great team to back. Is that a fair consensus?
Yeah.
Yeah. Okay. So
I think, yeah, but just to point on that, it's just varying degrees of growth. So, you know, we've got teams at Octopus that look for companies that can be billion-pound companies. You know, they are looking for the unicorns. They're looking for super ambitious growth. That's just what they do, and they're fantastic at doing it. And we've invested in things like Kazoo and Zoopla that have become those billion-pound companies. The actual team that I work in, we're not necessarily unicorn hunting. We're just looking, we're looking for companies that are actually just really good companies, potentially in their niches in quite small markets, but where we think we can make a decent return. So even within the VC community and the risk reward, you have some VCs like us in our team that are looking at 3 to 5, and then we've got other teams at Octopus that are looking at 10 times return on their investment. So again, that's why we just have to be careful and not maybe not be, if there's an advice to an entrepreneur, just because one VC says actually you're not right for them, that does not mean that all VCs, you won't be right for all VCs, because there'll be another one that maybe specializes in food and you happen to be a food company and that's the perfect VC for you, and you just happen to have come across a tech investor that was looking at something different. So that's my advice really, is they're not all the same, and just be careful not to take one word as gospel.
In the
and add to that, the corollary of that actually is that the issue I find most people when I raise finance, and I know that's what you're doing as well, to help people get over this, is that exactly what Edward just said, that they're kind of approaching the wrong people, or the wrong fund, or the wrong fund at the wrong time, and the point is, you've got to do your homework. You've got to understand is, what kind of finance am I trying to raise? Who should I be raising it from? Who's in the market that fits the bill? And they're the people you should be talking to. Not only are you wasting their time, you're wasting your time if you're just throwing mud at the wall.
So we're back to this recurring theme. I think Ed mentioned it earlier, as VCs are not just one thing. You've touched on it there, Piers, that essentially venture VC is a very big word. It's a very broad term, and it does include the more steady investors who are looking to make 3 times their money and hopefully not a lot of downside risk, and the much more ambitious ones that you probably hear more about in terms of social media coverage of those billion-dollar businesses. You know, that's sexy stuff, but there's a whole aspect, a whole segment of the VC world that isn't looking purely for unicorns. And so understanding that, any tips, guys, on for our sort of scale-up entrepreneurs to be considering who to approach? You know, if the starting point is, we know we need £3 million, £4 million to grow our business to the next stage, what's a good starting point, Edward?
Can I, yeah, this is an interesting one. So I have a slightly different view on this. So a lot of the time people say, that the word on the street is like, you should be very careful and targeted on who you approach. And I sort of get that. But actually, finding good deals is the hardest part of our job. Like, finding good deal opportunities is the hardest thing. People assume that you get thousands of opportunities and therefore it should be really easy. It's not. And so actually, if you've got a good opportunity, don't be afraid to send it to people, and they can only say no. Like, they'll only say no, or they'll pass by, or whatever. So I don't know. I'm much more worried about somebody thinking, oh, actually this person, I don't want to bother Ed with my opportunity because it's probably not for him, and then it'd be something that I really wanted to do. I'm much more worried about that than having a 5-minute email to say, I'm sorry, but it's not for us. So that's maybe just me, and there's probably other VCs that think slightly differently. I mean, I think if you are raising at that sort of level, so the level you're talking about into the sort of £3 to £5 million, I would say your best route is probably to find a good advisor, and there aren't many. There really aren't many at this level. Ian and his team are one of the few. There's a couple of others, that we see in the market, but there's not a huge amount of great advice. But what they will do, it's not just about the approach. The approach is actually the easy bit. It's the preparation of the approach that's difficult. And we see the amount of times that, I see a company that I think is slightly ill prepared for going out. You're asking for millions and millions of pounds and you don't have a very good financial model. You put some Excel calculator together in an hour, and then you're asking millions of pounds to be invested on the back of it, and you don't really understand what the assumptions are that are driving your business and the unit economics that are driving it. And that's where somebody like the Accelerator program that Ian runs is really useful, because they will guide you through that process. And I'm not just saying that because he invited me on here. I think the worst mistake you can make is not approaching the wrong people, but approaching people and not approaching with the right things and being prepared enough. Yeah,
agreed. So Ed, I think just to give some context to that, so we run two programs. We run within Whitehorse Capital. We support companies directly to get them ready to go out to a short list of the right investors with very warm introductions and help manage the process. And then a slightly earlier stage program, the ScaleUp Accelerator, helps companies get ready by putting in place the building blocks to get their financials in order, usually as they're kind of at or approaching £1 million of revenue. So they're the two paths that we kind of spend our time in. Within that, though, your comments there, Ed, on the preparedness, how to get ready to raise. So financial model you've touched on. Any other documents that you would expect to see for a Series A fundraise?
Yeah, my biggest pet hate, to be honest, is the 50-page PowerPoint deck. So you get this 50-page PowerPoint deck, which has got amazing clip art into it, all this sort of stuff, and then you ask for the financial model or the forecast or the business plan, and that's going to come later. I don't know how that has happened, but it seems to be that this focus on the deck first being everything, and then financial models and business plans being secondary. It seems to be a weird way around to me. To me, if you're trying to go out there and raise funding, build your forecasts first and understand the unit economics, understand what assumptions are driving your revenue, what assumptions are driving your costs, truly understand what drives your business and what happens in different scenarios. Then write your business plan. So because that will help you really think about it, and that should be a detailed business plan. And then after you've done all of that, at that point, put together a 15 slide PowerPoint, just giving an overview. And if I was going out, a couple of pages teaser document is probably all you need to spark a VC's interest, because, as I say, most of us have got quite a specific investment criteria. Now, if you are a B2B software company with £1 million ARR with good retention, and you've been growing at least 20% per annum, and you send me your teaser document, I can promise you we'll get in touch, because that's what we're looking for. Do you know what I mean? And so, you can do all that on a pretty small teaser. You doesn't need that massive deck. But if you then have the meeting and you haven't thought through your business plan, your model, and you don't understand what's driving your business, then that's what you should have done before going out in the first place.
Yeah. Okay. So we're recapping with a business plan, a written business plan, ideally not just a deck, a financial model, typically 3 to 5 years, and then a teaser to catch initial interest. Or importantly, we often use teasers to quickly qualify out the wrong investor. So that the biggest challenge for entrepreneurs, as we all know, building businesses, is that there aren't enough hours in the day. So going out and speaking to 100 VCs, a load of whom are ill-targeted, isn't the best use of their time. One phrase I like to remind our entrepreneurs is, the VC, are they interested in your business or interested in investing in your business? There's kind of a key distinction there, and you could absolutely fill up your diaries with educating the market about what you do, but it doesn't necessarily get you any closer to term sheet. So business plan, financial model, teaser, and then a bit of preparation around the data room to get ready for some due diligence, which is essentially when a VC will dig in and really try and get comfortable with the details once they like the flavor of the business. Anything else you would add, Piers, to kind of the level of preparedness that entrepreneurs should embark upon?
I was going to say time actually, but you should have stole my thunder on that one.
Sorry.
So yeah, do you not underestimate? You know, you're trying to build a business, and as Edward was saying there, trying to grow at least 20% a year. For his particular fund, some funds will grow much faster than that. And you know, do you not underestimate the amount of time and the distraction that can be caused by trying to raise finance, and also just the headspace and the stress that can I raise it, will I raise it, the valuation. So you know, having someone to support you can make a big difference. And the way I look at it as well is I look at it as a sales process. So if you look at it from you're the company, it's a sales process essentially. You are trying to sell this opportunity to these investors to raise some money. And if you think about a sales process, you know, you have your prospects, it's the universe, the VC universe. You then do what Ian was saying, you go and talk to someone and you qualify them in or out. Do you fit? Are they interested? Is it worth having a conversation? So you've now qualified them. Then you go and meet them and they start asking questions. If they're not asking questions, they're probably not that interested. If they're not asking you questions and you have qualified them in, they've qualified you in, then you're into a process then. And then when you're selling something, it's about, you know, ticking off the reasons for them not to buy your product, or in this case, not to invest. So if you're answering questions, and as Ian said, you're prepared, so you can talk about the model. And the financial models, you know, I was a lawyer, but I've got an accounting degree as well, so I can write a financial model. It's not really, Edward, sorry if you think I'm wrong, it's not really about how, you know, knowing exactly what your EBITDA is going to be in year 3. It's about just having a financial model that allows you to test the driver. So if I move that or I change that, what happens? The growth, the margin, the number of people I need, you know, how big the office needs, but whatever it is, you have offices these days. So it's having that ability just to test your thinking and your sort of your organizational structure actually, because that's going to be reflecting your financial model, and that's what you need to have. So I think they are the key tools to have. And again, I think that, as Edward said, the financial model, it was quite interesting, Edward, to hear that the deck's now 15 slides. It used to be 25, then it was 20, and now it's down to 15. So I've made a note of that myself. So they're getting shorter by the
Can I just confirm, by the way, I 100% agree with Piers, by the way. The financial model, this isn't, I don't mean like it's some sort of Excel test that you need to go through. It's just that I need to know that you understand. You know, I looked at a business the other day and they were like, we're going to sell, you know, we're going to sell £5 licenses on an annual basis. And I'm like, okay, well, how many customers do you need? Okay, well, that means I need like 10 million customers. Okay, well, how much does it cost you to acquire a customer? Oh, I don't know how much it costs. It cost me £10. Okay, so you're now acquiring customers at £10 that are giving you £5. It's like, you don't understand what's driving your business here. You don't understand, you know, you'll never hit your forecast. Just be clear, the forecasts aren't there to be hit. The forecasts are there to understand how to develop your model, and whether you're selling widgets at one price and it's costing you much more in order to do that. And then on the other side, just a very last point on this, in the terms of time, we actually model in a dip. You know, when we're thinking about our investment case, we assume that management teams post-investment are going to have a slight dip in what's going to happen for a few months. And we try and work with management to build 100-day plans to stop that from happening. But it takes so much energy, effort, time, as Piers has kind of described, that naturally management will probably dip slightly. And we're almost, you know, history has told us that we should almost expect that.
Which I think there's a secondary point then on, because you both mentioned the time and the implications of the fundraise. I mean, we see, even with a well-prepared business, you know, an enthusiastic management team keen to raise, it's currently a 6-month process from the point the kind of documents are ready to go out to market. It might be a month of qualifying first stage meetings. The second month is second stage, third stage meetings, getting to interest, negotiation. It might be the third month is agreeing the terms and getting clear on the detail of what's going to follow the summary term sheet. And then the VC will often ask for 30, 45, 60 days to do their due diligence exclusively. So where you say, we're not going to be talking to anybody else while you look into our business. The due diligence may cover HR, operational, technical, legal, financial, commercial. It might involve referencing of clients or key management team members or key prospective hires even. So there is a lag. So you see quite easily, you can be sort of 4 or 5 months in if nothing slips. And at the moment, I mean, we did £33 million worth of deals post-pandemic in 2020. And we saw them all taking a bit longer because it was harder for the VCs to get comfortable with management teams that they were meeting, only remotely. And has that been your experience, Ed, as well? Is kind of deals taking a little bit longer at the moment?
Yeah, it's an interesting one. I think for the first 6 months, we didn't know if we'd ever do a deal because we didn't know if you could do a deal over Zoom. And then I completed a transaction to a company called Perfect Ward, who does quality inspection in hospitals. So it's helping to improve. I simplify. It's helping to improve the overall quality in hospitals. And it was quite funny at the end of that call. The CEO said to me, "The one thing is, Ed, I've got no idea how tall you are." Because we'd never actually met in person, and that was a £4 million check. So it just proves that it can be done, and in some ways Zoom speeds things up. But I think the way in which you've kind of mapped out the overall timeline is absolutely right. Even if you're a really hot prospect, if you like, in terms of the company, most VCs are going to want to do their diligence, and they're going to have to go through their investment committee processes, and they're going to have to document the legals, and there's going to be some rounds of negotiation. So yeah, I think a six month window is probably a good way of looking at it. You might be short, you might get away with 4, but.
And to your point, the challenge there is not seeing this as a complete distraction that decimates the current year forecast. And I think from the entrepreneur's perspective, if you think that through, if what you're saying to the VC is back us, we know our business, we believe our forecast, they're all very sensible, and then at the point that they're doing their due diligence, you showcasing that you missed the last month and you're probably going to miss the current month, and the pipeline isn't looking very good for next month because you've been distracted by the fundraise. What message is that telling the VCs? It's probably not going to be taken well from the perspective that you're in charge of it all. They're going to think, yeah, a little bit of it is distraction, but you should have factored that in. So I think one of the points we generally would advise is that management either go into that with their eyes wide open, that it's going to be a distraction, it's going to take time, or they work out what can be delegated, so that they are not responsible for the whole of the business, all of the sales and the VC campaign and the ongoing tech development and the key hires. So getting that kind of next layer of support involved.
A well-prepared data room can save you a huge amount of time, is what I would say. So a data room, you can do it on Dropbox or whatever. You don't have to pay huge amounts of money for a data room, but just making sure you've got all your contracts in one place, you've got all your, customer agreements in one place, you've got your legal agreements together, you've got all your forecasts, your accounts, and everything that anyone could possibly need. Just having a data room in one place that's really well organized and managed can be really useful as you go through the process. And I would also say, if you've got a reliable person within, sometimes it's the FD, sometimes it's the head of growth, but if you have one person outside of the CEO that can be dedicated to the process as well, that seems to work well. And companies that do that tend to run quicker into the next phase of their growth after they've had the VC investment, if they've been sort of well prepared, and that then comes down to advice as well. Going in it sort of blind and unprepared is the worst, because you're going to get caught out.
Yeah, Piers.
I think also I would add that at the end of the day, can I put this nicely, Edward? It's business and it's a negotiation. And if you're an investor and you're a VC, the best way to improve your return at the end of the day for any given return is to reduce your entry price. So if you're reading the hot property, if you haven't got your numbers quite right, or you haven't got your liquidity that you need to get through a funding process, and you find that a month out, and because of some COVID or whatever it might be, the timeline's been extended by a month, and you're going to run out of money, and also trading's has created because you're being completely distracted by this process. You can expect the investor at the end of the day to have a conversation with you about the valuation that they're coming in at. Now that can be quite harsh, but you need to make sure that you really are prepped going in, and that you do understand that this is going to take at least 6 months, and you've got the funding to get through a process as well, because that can be another issue that can become not just potentially fatal, but super stressful.
Yeah. You wouldn't want to run out of money mid campaign to be raising new VC funding.
Yeah, I'd be interested, Edward, in your perspective on that, because you hear the stories of they drag it out because they know people are running out of money, the horror stories, and some funds, real more unscrupulous ones, might do that, but there is a point, isn't there, where if your trading's really taking a hit, you're going to want to understand what's going on. It might impact your entry price. I don't know.
Yeah, I mean that's. I mean, I hope that we at Octopus wouldn't act like that, but there is definitely that. Okay, what's your burn rate? And if the company's about to, not survive if it doesn't get funding next month, then you're in a very strong negotiation position because another VC can't get up that curve quick enough. And I have heard, you hear companies say, oh, well, we've got 6 months of runway, so I'll start in 3 months. And you think, well, that's madness because you want to end with you want to know that if the process falls over, and processes fall over for all sorts of reasons, that you've got the runway to go again. One thing that I shouldn't say, this is absolutely not the kind of mantra of what a VC would say, but I would definitely say is that people often talk about valuation, the way to get the best valuation. The way to get the best valuation is to build competition. So if you're a great company, and you'll probably have 3 or 4 VCs approach you and say, hey, would you like investment, and come to us and we'll be, come under our wing, we'll do it directly. You don't have to worry about going out to the market and all this sort of thing. And by the way, we do that as well. And, we target companies. But if you really want to push valuation, there's nothing better than competition, supply and demand. If and that's again, where you get good advice to go out there and actually go to multiple parties. And the best thing you can have is multiple VCTs sort of pitching to invest in your business. And I said, what I should say is, no, just come to us and we'll look after you. But the truth is that the more competition, the better terms you're going to get. So, and that's the same when you sell a business as well.
And to our audience, I promised that we would be demystifying the process and giving you some secrets. So there was one, which is you could go to Edward and he might make you an offer. But if you go to Edward with some other offers, he might make you a better offer. So. Okay. Last coming to the end of my questions. So from the audience, if you've got any burning questions, feel free to type them in the chat, and I'll try and pick them up in a moment. From a qualification perspective, Piers, you said VC isn't for everybody. So who is it for? Give us some ideas of the kind of businesses, whether it's based on their revenue profile, their sector, their traction, their plans, how scalable they are or not. Any red flags, any key areas that will help our audience think, yep, this is for me. This could be relevant, or actually this isn't.
I think there's 2 facets to that. So is it for the business, or is it for you as the the CEO, the founder, whatever you might be? And I think that in terms of the business, what people need to understand is that if you take on, so a lot of these, the West Coast kind of model that Edward was referring to, if you take on venture, especially sort of early stage tech, they're expecting a return, right? And it's not 5x. So they're expecting a certain return. And as you begin to grow and you think you need more money and you bring somebody else in at now a higher valuation, they expect 10x, 20x, whatever it might be, even more actually. So you need to really understand, I think, venture capital and their model and how they raise money and 10-year funds and how long they got to invest and what may happen at the end of that fund. You got to understand that they're looking often for 1 or 2 absolute flyers that returns the fund, and some that don't work out at all, and some that do okay or just bumble along. So you need to understand the venture capital model. And once you understand that and the relationship in terms of that relationship, having other people involved, people sitting on your board, having governance, having consent rights, having veto rights, there's a structure that comes with venture capital that you need to be comfortable with. And the pro is access to capital, which is super important if you want to grow a business or scale up, because you're probably not going to be able to find that kind of money anywhere else. So there's a quid pro quo. If you want that kind of cash, people clearly are going to want to try and protect it and manage it in a sort of appropriate way. And that's what the shareholder agreement is all about, essentially, in your sort of constitution. So one is about the business. I think the second one is about you. Is venture for you? And that's really a personal thing. That's about, do you want to some extent, no matter how you cut it, even if you've got 80% of the business, you are ceding to some extent some kind of control, in terms of absolute control over that business and its destiny. And worse things, I've had people that have raised these amounts of money, maybe 25% of their company, and they haven't performed or they've had issues, and they end up not working for their own company. And they've ended up, not quite a bad lever, but they've had the shares bought off them, for some reasonable amount of money, but not what they were hoping. So just understand what comes with it, and then make sure that you understand the pros as far as you're concerned. That growth capital really outweigh what you might see as the cons. And generally, if you've got a growth business, you need to access kind of cash, and there's no other really way of doing it. And you have to find and invest people who are going to back you, that will come up with a deal be happy with, and that's where you need a good lawyer.
Okay, good stuff. Ed, any different view on kind of who would qualify for, who should be serious about raising VC funding?
Yeah, I mean, I think there's a good point there, and again, this is not all VCs are the same point, but understand what your VCT wants. So there is the VCs out there that want 3-year turnarounds on their investment and want to make 5 times or 10 times in that period, and they have their own investors and they're looking for exits. One of the beauties about VCT funding is that we're evergreen investors. We don't really mind whether it's 2 years or 10 years, and so understanding where your capital is coming from and the wants of that VC are really important. I think there's nothing wrong with organic growth. I think there's this raising money for raising money's sake is not worth doing, and I have seen that. Where the company raises 2-3 million quid, then spends it all on magazine advertising because they weren't quite sure what to do with it. And they would have been much better off just growing organically until such a time as they have a very specific requirement for the money. And one thing I would say, and a good lesson to any entrepreneur, is that you can only give away equity once. So or you can only sell equity once. So you hold on to it with everything. Don't give it away cheaply. Don't raise because you feel like you should do. Raise because there's a purpose to doing it. And be very, very protective over that equity, because you can't sell it twice.
Brilliant. Okay, well, thank you.
No, very quickly. So you touched on a very important point there, actually, which is patient capital. So if you've got a business which is a deep technology, for example, you're probably going to find that the average kind of 3 minimum, normally 5, 7 tops year investment window actually it isn't enough to develop that technology and really create a product that you can go to market with that's worth something. I think VCTs are one, they're evergreen as well. British Business Bank, invest by British Patient Capital, but also be aware, absolutely what Edward said, that time frame, because otherwise you're going to find that either they want to flip you to a new investor, then you have to go through the whole process again, no good reason, or you just end up with an expectation gap in terms of how much runway you thought you had with them and how much they want to have with you in terms of and it's not a personal thing, it's just the way their funds are structured. So do you think about how patient the capital is that you're raising?
Brilliant, thank you. I'm gonna pause there. I'll just put in the chat the kind of link to the 2 ways I mentioned earlier that we can work with companies. If you're in the chat, feel free to raise your questions there. I see we've got three or four questions. So the first one was an interesting one about your thoughts on ESG. So how has this changed the game in terms of your perspective? The actual question from Stephen Lua, if I'm saying that right, hopefully Stephen, was, what's your view and approach on the ESG angle? Alignment with UN SDGs is an important criteria for us in view of raising capital from ethical investors. So any strong views on the role of ESG?
Yeah, we have quite strong views on this at Octopus, actually. So Octopus is one of the few larger investors that's a B Corp. So hopefully people know what B Corps are, but if you don't, have a look at it. So the way in which we go about what we do is as important as what we do. And I think VCs have a massive role because they have a role in 3 ways, which is one, within our own teams, looking at diversity and inclusion within our own teams and the way we operate. Then the way in which we invest, it's proven time and time again that there's lots and lots of subconscious bias about the way VCs go about making their investment decisions, and we need to do better at that and be conscious of those unconscious biases. And then we have a responsibility within the portfolio companies themselves and helping the portfolio companies do better. And that isn't that isn't from sort of just a sort of altruistic view. It's actually proven time and again that more diverse, more kind of longer term macro focused businesses do better in the longer term. And so we talked about our talent team, and part of what we do, for example, is help our companies, if they don't have them already, have things like D&I policies. We help them ensure that they are
diversity and inclusion.
sorry, yeah. And then, if one of the biggest things that's happening right now as we move to the cloud is that, data centers are taking hundreds and hundreds of power stations worth of energy up. And, we're trying to help companies go, okay, well, how can you think about that? And you can think about your carbon footprint and this sort of stuff. So we have a huge role to play. And I think that is both from wanting to do the right thing as a B Corp, but also I think other VCs are having a lot of pressure from their LPs. So their limited partners, their investors, institutional partners want their GPs, the general partners who are managing their money, to think hard about this stuff. So the pressure is coming all over the place, and it has moved. I think Octopus has been a company that's just done it naturally for a long time, as I said. But I think the whole market is moving that way. But hopefully, it won't just be sort of window dressing.
Good. Okay. Brilliant. Thank you. I think the second question from Stephen. I'll target at Piers first, because you've had involvement in both of these two aspects of his question. Was, what's your view on an exit strategy via the SPAC market versus a traditional IPO? So I can't think of many people better to answer that.
Yeah, but they've touched on, I can't but touch on D&I. So, I was a champion of the British Business About Research Alone Together report. And, if you come from a minority ethnic background, including gender as well, actually, you have to work harder to raise finance. So, be prepared for that. And ESG is increasingly important. And on a macro level, it is going to start because, as Edward said, diverse businesses, sustainable businesses are more profitable businesses. You are going to see ESG and that kind of strategy, having a credible one, impact capital allocation. So it will impact your ability to raise finance. So the other question about SPAC. So I used to do these sort of hedge fund investments back in the early, 2004 or 5, and I heard of SPACs then actually. So I went to raise a SPAC, £60 million SPAC, and it all looked great. And then the US model changed, and it was more efficient for the hedge funds, so it didn't happen in the end. And now they're back. So essentially, what the idea behind the SPAC is, we talk to people like Chamath, for example. Look at Chamath, is that he's one of the SPAC king in the US supposedly. Is that essentially the access to capital markets, and this is it's one of the big exits in terms of investors in the especially the US tech market. It can be very difficult, and there are doorkeepers to an IPO, and lots of people to feed on the way. And what SPACs do and direct listings is provide another avenue, another route to creating liquidity and becoming listed. Now, SPACs can have their own issues in terms of they might not be as liquid as you might want them to be if you list a company that way. You can be paying a premium for a bank account essentially, so you've got to think about that as well. But I think they're here to stay, as are direct listings as well. And I think the more ways that businesses are able to access the markets and liquidity for their investors, it's a good thing. But a SPAC essentially is in the UK we'd call it a reverse takeover into a cash shell. It's nothing new. It's just they've got some funky structures for the hedge fund investors. It's nothing new. It's just a way of a company on the stock market with cash buys your business. You might be bigger than that business. Essentially, you put them together. You've got the business, you've got the cash, which is what you kind of do in venture as well, and you combine the two, and then you grow the business. But the terms of that agreement need to be very carefully thought about, because it's not an IPO. You actually have a counterparty that is very much it's a zero-sum game. It's trying to get the best deal possible. So I think it's good. It's here to stay, but these things, like anything, will evolve over time.
Okay, good stuff. Thank you. Just conscious of time, we've got 4 minutes and there's still a couple of questions to get through. So if we can maybe keep our answers short and precise. Neil Frost from the cyber company Bob's Business has said, how best to re-engage VCs that have passed on you in the past, perhaps when your business has now moved on and progressed? Is it okay to go back to those investors? Ed, any thoughts on that?
Yeah, I mean, I go back to what I said before. Origination is hard. Like, finding good deals is hard. So I've just put terms out on a business I passed on 2 years ago. And in fact, well, do you know what? To be honest, I didn't pass on it. One of my colleagues decided we should pass on it, and we together collectively did. And that business is now probably valued about 5 times what we would have gone into it, a few years ago. I'm not bitter about that, obviously, but I think for a good business, and it's good, and you go about it in the right way, there's absolutely nothing wrong with re-engaging, and I'd actively encourage it. that has happened multiple times to us, where we've had a company with, like, maybe it's I don't know, 300,000-400,000 ARR, which is kind of below where my team goes. Our other teams go that low, but my team tends not to really get involved in sort of 1.5 million. And they've come back to us and said, look, we've pretty much hit our business plan. We're at the sort of 1.5 million, 2 million, and then we've been like, great, let's keep talking, let's get on with it.
Okay.
You know, so just stay in touch.
So the answer, Neil, is essentially go for it. Get back in touch. Tell them what you've learned, what you've changed, how you've progressed, how you've moved on.
They can only block your email. I mean, like, you know, what's the worst that can happen?
Okay, good stuff. We've got a question from Paul at Scenic, and so Scenic, we know Scenic is powering BT Sports Watch Together aspects. So you kind of know a little bit about what they do. Paul's question is, how important is it that the company owns their own tech stack versus piecing together others' paid APIs to create their solution? And if they do own their own tech stack, does that improve the valuation much?
That's a good question.
Edward,
I'm interested in your response to that, because just to give some color, I'm looking at that now. We're building parts and other parts, which are a very big company to do very, very well. It's not quite how we would do it. And it's that buy or build. How do you, what's your view on that?
I mean, we haven't really got time, I guess, to go massively into depth here. And again, this is, you know, different VCs. If you're a deep tech AI in VC, then you'll want that tech stack to be your own, and you'll pay for that. From my point of view, I'm less worried about it. I'm actually more worried about the moat. If you're using other people's, you know, API, if you're using APIs to bring in other people's stuff, and you're using other people's IP, you know, what's your moat? What's your defensibility? You know, like, what's to stop other people doing the same thing? So if the answer is X, Y, and Z, and there's clear reasons for that, then actually I don't wouldn't really bother me. Not for me, not for the team that I work in, because I'm more worried about is how sticky is your revenue base. You know, how sticky are your customers? How much do they love your product? You know, with what you're doing. And I've seen a few businesses, you know, especially in things like, you know, KYC, anti-money laundering, where there's just so much information out there. You know, and actually a tool that enables you to kind of clean all that up and put it in a usable form is actually really useful, as long as you can defend it. You know, that's what I'm more worried about. But again, you know, horses for courses, that's just our team.
Okay, good stuff. Well, I think we're done, guys. We said an hour, and Ed's running off to another board meeting. So thank you very much. Hopefully that was a useful session. I've put my email and our URL back in the chat in case you've got any questions arising from this. But otherwise, just to say thank you very much to Edward for giving up his time. Thanks to Piers for sharing your insights, and Irene for catalysing and hosting. And hopefully some useful nuggets there, guys. So as Irene says, good luck and carry on scaling. Thank you all.